While Q1 earnings were a washout for India Inc. as the COVID-19 induced lockdown had forced the economy to shutter down. Let's do a three-point analysis to find out if Q2 of FY21 earnings will reflect any signs of recovery. 1. How is the second quarter likely to pan out for India Inc.? Well, most of the market analysts currently believe that earnings in Q2 are expected to fare much better as businesses have now emerged from the complete lockdown that was weighing on in the June quarter, and also which caused unprecedented supply chain disruptions in the preceding 3 months that we've already seen. Now, they also believe that the earnings rebound will actually be helped by lower input costs, cost-saving measures, and also a demand recovery that right now we are seeing. The key factor to watch out for will be the management commentary on demand ahead of the festive season and also the resilient strategies of companies to really combat the disruptions from the pandemic, which has really led to a massive loss of household incomes. Now, if you also see too, which sectors are likely to buck the trend? Well, if you see, analysts do expect that Indian IT services will actually make a strong comeback and also post robust numbers in the September quarter. Also, if you see, TCS has already kicked off the earnings in the segment with strong quarter and also upbeat commentary right now. The overall IT firms are also expected to report stable Q2 earnings with healthy deal pipelines, the easing of supply constraints, and also the continued control on the discretionary costs and spends. The pent-up demand is also expected to aid volume growth in sectors such as automobiles and consumer durables. The auto sector has already witnessed a sharp recovery across segments, and that is led by the rising preference of personal mobility. Pharmaceuticals is expected to stabilize on the macro drivers of earnings led by higher export revenue. Also, new launches, improved product mix, and favorable pricing will really drive the margin expansion for pharma. Now, FMCG and telecom sectors are also expected to stay relatively insulated from the turmoil and report resilient performance in Q2. Now, with uncertainty surrounding AGR case now behind us, the ARPU, or the average realization per unit, is also expected to post a modest uptake. Analysts also expect rural demand to continue to outperform the urban demand, aided by the government-focused relief packages which the government is giving. Also, FMCG companies may show growth led by hygiene and household insecticides categories. Lower crude prices and also a stronger rupee could definitely benefit few companies as well. 3. Which sectors will be disappointing then? Well, ICICI Direct report really suggests that manpower-intensive sectors like infrastructure, capital goods, they may see decline in the operating profits given the site-specific lockdown and work shutdown due to the monsoon, albeit lower than Q1 as well. Similarly, with full resumption of economic activity still at a suboptimal level, the pockets such as discretionary and retail will still report a decline in earnings in Q2. Now, for the banking sector, economic indicators have already suggested improvement in activity. Recovery process, however, could actually take more time as COVID-19 cases continue to remain high. FY21 as well would be quite stressful for banking and NBFCs with respect to higher NPAs and also lower credit growth. Brokerage firm IDBI Capital believes that cement industry's volumes could actually decline by 15% year-on-year in Q2, and post-June 2020, the decline in cement volume has actually increased as pent-up demand has faded and monsoons also set in. Overall, it could be a mixed quarter as the recovery for some sectors was again marred by the local lockdowns and the limited easing of restrictions.